I'm going to reveal the exact strategy I use to make a passive income on my crypto assets by utilizing decentralized finance. Let's hop in. First things first, I do want to go ahead and go over some credentials. I've been in decentralized finance for about 2.5 to 3 years by now, and I've been in crypto since I was 13 years old. With that being said, I've been running a public portfolio since the beginning of May, and I've been able to return a consistent 40% APR on my assets without taking on an absurd amount of risk. One thing that I do want to go ahead and mention is that I stick to blue chip assets like Bitcoin, Ethereum, Matic, Link, Render, stuff like that, and stuff that I actually believe in. My investment thesis is to obviously look for different cryptocurrencies that have utility in them, put them to work and earn a yield on my assets, and then go and compound that yield back into just simply opening up HODL positions. So if we look at my yield farming positions since May, I've been able to make $3,500 in passive income, and that $3,500 has been compounded back into my portfolio. Occasionally, I will compound it back into my yield farming portfolio, but a lot of the times I will take that $3,500 or whatever yield or earnings I get and just use it to buy the assets that I believe in and dollar cost average. That way, I'm able to increase my exposure to these assets that have maybe higher amounts of risk, but also a really high return without having to risk my own capital and inject more capital into DeFi or crypto. Additionally, I do have some holds that I'm able to stake for a return, like Ethereum as well as Matic, and I've been able to generate $573 in earnings just from staking those assets, which is pretty nice. So the simple concept behind this is I find different yield farming positions with assets that I believe in, like let's just say Bitcoin, Ethereum, Matic, Link, and Render as I talked about earlier, and I'll earn a yield on those assets. Currently, the portfolio is doing about 50% APR. It's also available for you to track in my free Discord server, which is linked down below in the description. And 4 out of 5 times, I take those earnings and I claim them and I compound it back into my HODL portfolio, which is just simply assets that I believe in that I'm willing to hold until the next bull market. But the thing is, I'm not constrained to compounding back into the HODL portfolio. I could simply take that 50% APR, sell it to cash, put it in my bank account, and live off of it if I really wanted to. And I do want to say that 90% of the positions that I invest into are concentrated liquidity pools, and 90% of the concentrated liquidity pools I invest into are on Uniswap v3. That is simply because Uniswap is the largest decentralized exchange out there. Currently, it has a TVL of $3.34 billion. Now, overall, DeFi has a TVL of $41 billion, which means that Uniswap has a huge market dominance over the entire DeFi market. Now, the simple concept behind Uniswap is it's an exchange, just like Binance, just like Coinbase, where you can trade one asset for another asset. But it's a lot more simpler and it's a lot more user beneficial, I would say. And that's because it's completely decentralized. You don't have outrageous 2 to 3% fees like Coinbase has. You have a small liquidity provider fee, which on certain assets could be as low as 0.01%, whereas it could be as high as 1% on very volatile assets. If you're trading Ethereum, you're probably going to have a 0.05% fee. But basically, when somebody swaps one asset for another asset, they're essentially putting one of those assets in the liquidity pool and taking the other asset out of the liquidity pool, which automatically adjusts the price and rebalances the pool. So for example, if I were to sell one Ethereum right now, I'm increasing the amount of Ethereum that's in the liquidity pool, which obviously normal supply and demand rules. There's more Ethereum in the pool, there's less USDC, which means that the price of Ethereum is going to go down. Whereas if I'm doing it vice versa, swapping USDC for, let's just say, Ethereum, then of course it's vice versa. There's more USDC in the pool, less Ethereum, the price of Ethereum goes up. But I can actually go and put my money in this pool, and anybody can put their money in this pool because it's a decentralized exchange and it's permissionless. And by putting our money in this pool, we're able to collect on that 0.3% to that 0.05% fee that the trader is paying on the decentralized exchange. Now, of course, that's a very high level overview of what liquidity pools are and what automated market makers are. There's a whole nother concept called concentrated liquidity where you can enhance your capital efficiency, and instead of getting a small measly return of 1.67% on Ethereum, you can get upwards near a 50, 60, 70% return on Ethereum depending on what your liquidity is ranged at. As you can see, if we were to use a range of like, let's just say 1660 to 1830, we're estimated to do about a 70% APR on Ethereum. And of course, the broader we go, the lower the return that we are going to get, and there are risks that are associated with this. And if you guys do want to learn more about concentrated liquidity, drop a like and subscribe with notifications turned on because we have a ton of YouTube videos about it. Additionally, we did just release a concentrated liquidity mini course, which is literally only $30, and it's going to go over all the key fundamentals of Uniswap v3 and concentrating your liquidity. The link for that mini course is going to be down below in the description, and I promise you it is going to be worth your $30. Now, to talk more about cryptocurrency as well as decentralized finance, I want to quickly run through some different cryptocurrencies. If we pull up the Bitcoin chart and we look at Bitcoin over the past year, obviously it saw a run at the very beginning of 2023, but it also has its setbacks. So Bitcoin ran all the way up from $17,000 to $24,000 before going down to $20,000 and then back up to $30,000, but then going back down to $25,000. Now it currently sits at $34,000. So obviously Bitcoin price has been moving. Yes, it has been consistently going up over the past year, but of course that consistent price action does come with setbacks at certain periods of time where Bitcoin is ultimately super bearish. But of course those consistent returns do come with setbacks along the way where Bitcoin is bearish for a period of time. Ultimately, if you believe in Bitcoin, yield farming with Bitcoin is an absolute no-brainer because you're able to increase your exposure to Bitcoin. So in the long run, if let's just say Bitcoin goes up to $100,000 and initially you have one Bitcoin, well, somebody that's just holding one Bitcoin is going to have $100,000, whereas somebody that's yield farming over the course of, let's just say, a year, earning a 35% APR on their Bitcoin, is now going to have 1.35 Bitcoins. Meaning, instead of having $100,000, they're going to have 35% more. They're going to have $135,000. That is my exact strategy. It is simple, yet it's effective. Now, with that being said, it is a simple and effective strategy, but it does not come without risk. Obviously, there are risks associated with everything. There's risk associated with just simply holding your Bitcoin, whether you're on Coinbase or in cold storage. There is risk associated with everything. Here, you are taking on more risk, but you have to ask yourself if the reward outweighs the risk that you are taking on. If the risk to reward ratio is good for you, then go ahead and do it. And personally, I'm putting my money in platforms that I honestly trust. I've talked to the team members there. I've asked them questions. They have cleared things up, as well as these projects that I invest into have billions of dollars loaded into them and have been around for years on end. Uniswap itself has been around since 2018, and DeFi was actually invented in 2017. Basically. Uniswap itself has been around since 2018. It's completely decentralized, and the cool thing is DeFi was actually invented in late 2017, early 2018. And the best part is Uniswap was the first decentralized exchange, and now the decentralized exchange industry is a multi-billion-dollar industry that makes up for about half of the overall DeFi industry. Now, if we take a look at this Coinbase transaction, the total buy amount is $10,000. And you can see that there's a Coinbase fee associated with this purchase. That Coinbase fee is $184 normally, which is literally 1.85% on that overall $10,000. However, I do have Coinbase One, which is about $30 a month, and it waives all fees up to a purchase of $10,000 per month. But the thing is, if I'm trying to buy 15,000, 20,000, 30,000, or maybe even at institution levels, 100,000, $1 million, $2 million, $10 million of Ethereum, this is obviously not logical to trade through Coinbase. The fees are absurdly high and they are going to affect your cost basis. Additionally, there is a premium attached to the actual price of Ethereum. Ethereum trades at 1802 per Ethereum token on Coinbase right now. If we go over to CoinGecko, Ethereum is currently trading at 1784. And same exact thing if we go over to CoinMarketCap, Ethereum is also trading at 1784. One Ethereum on Uniswap is also estimated to be 1784. Now, obviously, Coinbase is providing a service. They're making it super easy for you to get onboarded into crypto, and Coinbase is a key player in this industry. But people that actually want to take things further should not be buying on Coinbase, in my personal opinion. They should be using a cold wallet. They should be using decentralized exchanges so they can avoid these fees. To compare, if we were to trade 10,000 USDC, which is equal to $10,000, for Ethereum right now over on Uniswap, we're getting out 5.59 Ethereum on Uniswap basically. Compare that to the 5.54 Ethereum that we're getting out over on Coinbase. This ultimately does affect you if you are trading. One thing I do want to go ahead and mention is you could get a way better return by using a decentralized exchange aggregator. Because in this case scenario, you are paying a fee to a liquidity provider, but the Uniswap front end does charge a 0.15% fee. And that fee is obviously one of the lowest in the industry, and it's just simply there to support the Uniswap development of the actual protocol and keep them up and running, obviously. And with that being said, all the centralized exchanges do charge large fees like that. It is not just Coinbase. There are a lot of exchanges that do charge higher fees than Coinbase. Crypto sparks a big concern with regulations because it takes the power out of the government and out of centralized authorities, and it puts it in the hand of the people. So obviously the government does not like that, and that's exactly why they go after different exchanges like Coinbase, and that's why Coinbase and other exchanges have to charge those large fees. But when you're trading completely decentralized, and what I mean by completely decentralized is I can head over to a website, and without opening an account, without entering in my KYC information, without having to be an accredited investor, I can click in the top right corner and hit Connect Wallet. And after I connect my wallet, I am able to execute a trade directly out of my cold storage wallet. Additionally, I can do more than execute a trade. I can open up a liquidity pool, like this Ethereum to USDC one that I have right here that I currently have $19,000 in. I can increase my liquidity at any given time. I can remove my liquidity at any given time. Same exact thing for this other liquidity pool that I currently have $15,000 in. I can increase and remove my liquidity at any time, collect my earnings at any time, and I can invest into a brand new one at any time. Now, the point of this video video is, if you are willing to take on a little additional risk, and of course manage your risk properly, don't be completely stupid, don't invest into stuff that is too good to be true, then you could be increasing your exposure to the assets that you truly believe in cryptocurrency by a long shot. You could be getting more exposure to Ethereum. You could be getting more exposure to Bitcoin. Or as I said in the beginning of this video, you can take that money and use it as house money. If I make, say, $500 from my yield farming position over the course of a month, yeah, I could go buy more Bitcoin. I could go buy more Ethereum. Or I could be a little bit more risky and I could go buy an asset like SHIB, or I can go buy an asset like Pepe or something like that. And ultimately, those are assets that do have a high probability of going to zero, but at the same time, they have a high probability of going 10, 20, 30x return from here on out. And if they did go to zero, then obviously I don't really lose any money because I made that money by using my other cryptocurrencies and just yield farming. Whereas if they go 10x, well, that's great. I got a lot more money that I can play with and I could do whatever I want with that additional capital. And I do want to go ahead and mention, I do not care what you do with your money. This is not a sales pitch for you to get into decentralized finance. If you invest into DeFi, it does not benefit me whatsoever. I'm just simply here to share my thoughts, share my journey, and tell you exactly what I'm doing with my personal portfolio. And if you guys are interested in learning more about Uniswap V3 concentrated liquidity pools, I recommend you take a look at that $30 course link down below in the description. And with that being said, if you enjoyed, found this informative, drop a like, subscribe, and notifications turned on. I'll see you guys in the next video. Peace out.